Unfortunately, I had to record my presentation since I'll be traveling at the time of the live meeting. But lots of things have been happening, and I would love to share some of my macro views as well on this. And we've had the Federal Reserve meeting this week. We've had a lot of data that came out, and some of the behavior in the market that I think it's important to notice as we get into some conviction ideas and themes that we think will play out in this following years. But I can't help but notice the fact that the gold to S&P 500 ratio, or gold, has started again to outperform the markets. We saw this, as you can see in this chart, more recently in a big way, and then it actually peaked at the very since the market has been rebounding. But now we're starting to see that brief comeback of this ratio starting to rise once again. My opinion is that this is the beginning of a movement. I think we're going to see a much larger upward trend of the gold to S&P 500 ratio. We did notice that the metal has been outperforming the S&P 500 over 10 years and other tenors, even 20 years and so forth, and even all the way back to 2000. And I don't really, think this is as relevant, but I do believe that in the near term, this ratio is likely to rise. One of the things that we noticed in our research was that if you do an empirical analysis of once you get, if you look at the entire treasury curve of yields, and you think about how many of those have gone inverted, when we reach to that 70% handle of inversions in the entire treasury curve, empirically, we looked at a lot of macro assets, so not single companies, just looking at the from a macro standpoint, what are those macro assets that tend to perform very well? Usually you tend to see treasuries doing well, you could see gold doing well, you could see the market declining, but this is really going to depend on the macro regime we're in. If we're in a deflationary shock, treasuries tend to do better. If we are usually in a more inflationary shock, gold can do very well. But one thing we noticed that is remarkable about these types of analysis is that all the way back to the 70s, when we had the 70% of yield curve inversions shot up above 70, it usually triggers a moment where the gold to S&P 500 ratio tends to do very well for the next 2 years. We've been triggered on this one in 2024, and I would say that we're in the early stages of a bigger move in this environment. Now, that doesn't prevent to go not just for 2 years, but for much longer in terms of the horizon of how this ratio could actually be entering a long-term trend or a secular bull market. And I think that is the case here. Is going back to that idea of hard assets relative to financial assets that are very overvalued. And we're probably entering a world like this. I mean, notice what the Fed did recently here. Jay Powell, almost exactly a year ago, was referring to, we're not seeing the stag or deflation, if you recall. And now, if you look at the estimates that the Fed has actually released recently, clearly that is what they're projecting right now. And so when you think about this, the Fed is in a position where hiking rates and all these other things that tend to hurt hard assets are probably off the cards for the next few years. And if that's the case, it kind of gives a green light for a lot of hard assets, and also to see the inflation side of it running hotter than historical standards. And so that's sort of that supercharged environment, macro from a macro standpoint, that you tend to see where hard assets tend to do very well. Look at now the 2 versus stands. It's just a very specific spread of the yield curve that maybe first of all, if you look at those times when we get the inversion, a lot of people tend to think that the inversion is actually the recession, but no, it's a steepening after the inversion that we tend to see a recession unfold. And it is interesting how the interest on the media is so pronounced when the inversion happens, when it actually should be when the steepening is occurring post-inversion, which is precisely what's going on now. If you look at this chart, as the line is going up, it means that the yield curve is steepening, as you can see. And I wanted to go back in history all the way to the 70s and see, look, those movements tend to be at about 300 to 400 range, 300 to 400 basis points of a move on the yield curve. We've seen about half of that, about 150 basis points have moved, but there's more, as you can see here in this chart. So I would suspect that we're in the beginning of, or in the middle of, a yield curve inversion or disinversion or a steepening movement, and there are many reasons for that. Especially a recession play on the 2-year. Usually, when you we analyze these moments of the yield curve steepening, what tends to cause that? Yes, the entire curve tends to fall, but most importantly is that the 2-year yield is the one that falls the most, causing the yield curve to steepen substantially. And that's because the market starts to see the risk of a recession playing, in the near term, and therefore the 2-year yield tends to fall substantially. So that's the importance of this. Unemployment rate has been moving up over the last months or so. Not enough to maybe be in the Fed's radar. Therefore, why we haven't seen the move. And I believe strongly that the Fed is just waiting to, and I think I've said this before, but the Fed is certainly, in my view, waiting to see hard data deteriorate substantially before actually starting to reduce rates. And I believe that the 2-year yield is going to reflect that in a big way. So you may see this is a very unusual thought, because a lot of people think, well, if you don't think the Fed is going to cut rates anytime soon, why do you think the 2 years is going to fall? It's because it's a 2-year, not 3-month. The 3-month may stay where it is, but the 2-year is likely to collapse, in my view. And you can see this in this chart, which I think is remarkable. Well, unemployment rate has just gone up above its 24-month moving average, or the 2-year moving average, as you can see in the first panel of this chart. When you see that cross, usually it means that we're at the beginning of an upward trend in unemployment. As we see that unfolding, the usual movement in the macro side of it is that the 2-year yield tends to collapse alongside with that. That's my opinion. I think that's yet to occur in the markets, and therefore why I'm showing you this chart. Now, there is a separation of data that I think is also important to point out. We're seeing business managers, which are part of these ISM reports and other reports that happen regionally as well, the Richmond, the Dallas, and Philadelphia, and others. And what you find in those reports is that mostly businesses are seeing, deterioration on their end in terms of plans to do things. And therefore, we are in recessionary levels when it comes to sentiment across those folks. What is different, however, is if you recall from a chart from the prior presentation we had, there was a situation where we were showing that markets are still, or Wall Street analysts are still, hoping, or I should say, expecting that earnings are going to grow double digits for the next year in terms of the annual earnings per share growth. And to me, this is a big divergence between what managers are telling you and what Wall Street is telling you. And this is a classic divergence that doesn't end well, in my 2 cents. This is where you tend to see those negative, especially negative surprises on earnings, given the fact that stubbornly, a lot of these analysts have had their earnings estimates too high relative to what's happening in the world. This chart, you're looking at production specifically, and you can see, why do I like this chart? It's because it goes back to the 70s. It's got so much history, and you can see that the levels we're currently in this chart, it is per se a recessionary level. Notice the shaded areas in red, which are all recessions. Now, one thing that's also important to notice has been this movement on Apple alone, right? We've had Apple had a report here recently. Apple is likely to, as announced already, is likely to be spending almost entirely its free cash flow in order to buy back shares. At the same time, wants to do about $16 billion of dividends annually, which is an increase of about 4%. So you have a company, and why am I picking on Apple? It's not specifically picking on Apple. It's just because it is such an important security for equity markets today. I mean, Apple alone, as shows in this chart, has twice the market cap of the entire energy sector in the S&P 500, or 11 times the size of the entire metals and mining industry in the US. And so, clearly it is of a relevance that we need to be pointing out. Keep in mind that, a lot of people say, well, but Apple makes more money than these. Well, the energy sector makes exactly the same amount of money that Apple right now at these oil prices. So imagine at higher oil prices what that change would be. And no, Apple is not growing. For the last 3 years, we've seen flat revenue growth for Apple as well. So I'm questioning the valuation of these things, and also I would be questioning, this movement, or I should say, this move from management in terms of the shareholder-friendly policies, the $100 billion or so of buybacks, which is about their free cash flow, as I mentioned, another $16 billion or so of dividends annually that they have planned. If they're using free cash flow to buy back shares entirely, you still need to come up with the $16 billion. How you come up with that? Well, there's about $40 billion of that, of net cash in their balance sheet. Now, I'm old enough to remember when Apple had a fortress balance sheet with lots of cash, and it's been depleting that over time. And most likely, from my understanding of looking at what people that really cover the name, will likely see amounts of that debt increasing. So you're probably going to be raising debt in order to pay for the dividends as well. I think this is extremely problematic. You can add on top of everything is that the $100 billion of buybacks or the entire free cash flow they're using is also under threat because, they have announced they're going to be spending over $500 billion in the next 4 years, which is $125 billion per year. And I don't care if it comes from CapEx or expenses. That's a meaningless discussion because both will reflect on a significant decline, potentially even negative, and meaningfully negative free cash flow if they do spend those amounts today. CapEx now, just to give you some sense, is running at about $15 billion. So we're talking almost 10 times that amount in the next 4 years. Well, another thing to point out as we see these imbalances of equity markets where these mega cap companies are really high market cap relative to other parts. Notice what's been happening recently. If gold miners were actually a sector, they would have by far the best performance of the market in the last year. 43% return, while the second largest one looks to be either, I can't see, I think it is financials actually, but you can see clearly that the gold mining industry, I recall not too long ago, was seen as uninvestable, was seen as a part of the market that should be ignored because of the lagging effect relative to gold and so forth. But I can't help but notice this outperformance of an industry relative to others, despite the skepticism. I think those things are extremely important, and I'm going to touch on that here as well. When you look at the mining space and the profitability of these companies, one of the most important things for open pit projects in particular is energy costs. And this is a great chart going back to 1946. As you can see, the gold to oil ratio remains at the second highest level in history. That is almost 30% or so energy cost is of open pit mine today. Just to give you some sense. So this is where you see the big profitability of these companies. A lot of the mining companies are actually producing at almost double the all-in sustaining costs that they have been reporting over the last few years, given that the gold price is hovering around 3,300 right now. And it's also very important to notice that a lot of people are trying to take this technical view on gold, saying it's overdone, it's had a big move. And I'm holding my views on this. I don't think this is the time to be emphasizing technical analysis at all. And I think we're in the midst of a monetary realignment, and monetary realignments are not, technical analysis doesn't matter at that stage of where we are in history. And I do think we're going through that. Central banks are buying gold to a degree that we haven't seen in many decades, perhaps even centuries, the way we're seeing the volumes in gold prices and so forth. And so looking at, relative strength indicators, or all sorts of other technical numbers that people like to look at may actually, cause, unfortunately, a lot of retail investors that tend to get caught up into these short-term movements, end up missing a much bigger long-term opportunity. In my 2 cents on this. And so, I find it interesting when you see all these technical guys that sell research. Obviously, they're never running funds; they're always selling research on these things, and are having to explain those views after the fact, or they just shifted their views and pretended and never said that gold was, or silver was overbought or anything like that. And so, I like to focus on big long-term macro trends. Gold to me is extremely undervalued relative to a lot of things, especially money supply and other things. In this chart, you obviously seen that gold is overvalued relative to oil, historically speaking. That doesn't make me bearish on gold. It makes me very bullish in energy personally. So that's where I'm coming from in this whole research. Now, this is probably the most important chart of the whole presentation. And the main reason for it is because it's something I've been, sometimes you have these kind of issues. It's almost like a math problem that you're just thinking in your head and trying to understand, how do we fix this? How do we not fix it? Because I don't have control over fixing this issue, but how do we apply this in markets? Because it's probably one of the most important, stats that I've seen in many, even many years, perhaps. Notice what's been happening. We're seeing AI revolution take place. The demand for electricity is tremendous when it comes from those from those models and those data centers. And what we're likely to see is that a growth of another U.S. Economy equivalent of energy or electricity consumption in the world. And so, you have to think about it. How do we not fix this issue, but how do we accommodate another economy entering the space due to AI demands and so forth, in terms of electricity? Where is it going to come from? And so I put in the title of this chart, as you can see there, metals, mining, infrastructure. Now, to me, that's what comes down to. I don't know how you add that without actually investing a lot in metals and all sorts of metals that fit into the electrical grid or allow us to have the electricity consumption that is needed for this. I also think that mining is going to be a critical piece. We're going to see probably mining become a critical part of this whole administration as well. A lot of people came up to me and said, Tavi, why didn't you mention nuclear above? Folks, uranium is mining, number one. And nuclear falls into the infrastructure. Infrastructure investments are likely to be the case, from utility standpoint, from data centers. All these things are going to be part of this. I also would point out, if I would say that one thing that is not really being reflected on that title, it's not nuclear. It's actually emerging markets. Emerging markets should be part of this because a lot of these economies, and I can speak for Brazil, for instance, that are producing surplus on electricity relative to their demand. So imagine if you're a mega cap company and you know that there's a country that is producing surplus of energy or of electricity. Well, that gap is going to have to be taken by somebody. And I would suspect that some of these large companies with real money will likely be taking, some investments in those countries, of which should be very attractive for those emerging markets as well. Another thing to notice here is look at how China has been in this steady growth versus the U.S. has been, flat for many years. Now, what this chart assumes is that we're going to continue to see the same trends. I disagree with that. And the main reason why I disagree is not because of AI necessarily, but it's because of onshoring. If you look at China, the main reason why China has been in this steady rise, and that doesn't mean China won't benefit from AI and all that in terms of electricity consumption, or benefit, no, I should say, won't be using electricity consumption for AI. They will probably be one of the leading countries on that front. But the main aspect is onshoring uses a lot of electricity, and very likely, if onshoring is a real trend, of which I believe it is, for many reasons, especially deglobalization, we're likely to see the U.S. actually starting to rise and China lose a little bit of that rise relative. So the relative performance of the U.S. in terms of energy consumption may actually increase substantially relative to China. And as we see that occurring, we need to think about how the U.S. will solve this issue. So how are we going to solve this issue? Well, let's start with nuclear, which is the first thing that comes in people's mind. Nuclear will be likely an incredible investment in the future as far as fixing this long-term problem. But nuclear won't be here in terms of it's about 20% of energy a source in terms of electricity. It comes from nuclear today. Nuclear, even if we streamline approvals and permits and all that, will not be the answer in the next 5 years. Look at the chart. We're talking 2025 to 2030. We're going to add another U.S. economy. So think about this. Yes, nuclear is important. It will likely be the case in the future. It doesn't fix the next 5 years. Okay, so what is going to fix the next 5 years? Well, it comes down to really two or maybe three. One is natural gas. Natural gas is in the forefront of all this. It's probably the one that has the leading path to sustain this energy issue that we may see in the U.S. economy. Number two is probably going to be some combination of two, or I should say number two, number three. It's going to be a combination of two other things. One is a fast-growing industry, the solar energy space, of which we may see a lot of more solar panels, metals. Solar panels use a lot of metals as well. So we need to think about that too. So that's another one. And number three would be coal. The coal industry, even though it does have aging problems in terms of infrastructure, and we don't have anything coming online anytime soon, it could actually be able to expend a little bit of its energy. Not as much as natural gas, of course, but in the near term, it could also be another source of energy to fix this gap problem of AI demand. All right, well, let's go back to markets again, because I'm extremely bullish mining and extremely bullish emerging markets and other things. But notice this chart. Now you have mining companies. Again, remember when mining companies are uninvestable not too long ago in regards to an industry that has not been performing very well and will unlikely be performing well. That's what people say. I don't believe in that. And so, well, notice that relationship between gold miners and the euro. First, we had gold taking off, and then now the next I shouldn't say domino to fall, but the next in the sequence of facts here has been the gold miners. Gold miners have done well as well, because the underlying metal improves the profitability of these companies. And what comes next? What's the next thing to come? Well, junior miners comes to mind, of course. I mean, junior miners have not moved as much as the seniors. Number two, you can see the chart. The euro and gold miners have an incredibly close relationship. And we're seeing that the gold miners are potentially leading the way at a time when clearly the euro is at a very important inflection point in history. I showed this by looking at this resistance line that we bump up way too many times. And I believe very strongly that the euro will break out relative to the dollar in a big way and follow along with the gold miners as well. So to me, that's the next shoe to drop, is the devaluation of the dollar in a big way. The second shoe to drop, which is not necessarily a drop again, but notice that early 2000s, you saw the gold miners actually leading the Brazilian ETF, the EWZ, but EWZ did at that time bottom, and it started a long-term trend. I mean, just so you know, Brazilian equities went up 18-fold from that bottom all the way to 2011, in the early 2000s, all the way to 2011. And so we haven't seen that move yet happen. And it's not just Brazil; it's Latin America, it's emerging markets, and I picked Brazil for chart reasons here in this case. But I do think this is going to be that the mining industry is a leading indicator for the euro. It's a leading indicator for emerging markets as well. Notice the cycle of U.S. and Latin American stocks have a very pronounced change over the history. So in the first panel of this chart, you're looking at the orange is Latin American stocks, and the white is U.S. stocks. And you can see sometimes U.S. stocks outperform, sometimes Latin America outperforms. But investors have a short memory and tend to forget that these leadership periods tend to change over time as well. we've had, as you can see in the second panel, we're looking at the ratio, U.S. equities relative to Latin American stocks. And you can see we've seen one of the longest periods of outperformance of U.S. stocks versus Latin America. And I think that's, way overdue in terms of a change in the dynamic of this leadership as well. One of the last charts I have here is the equity performance of U.S. equity markets over 15-year period, all the way back to the 1970s. This looks like the second largest we've seen in history. Look, I think it's extremely stretched. I don't believe we're going to see another blue line like we're seeing right now. We're very unlikely, and usually on the back of very strong decades or 15-year performance windows, we tend to see the following 15 years to be very challenging. And so I think we've seen most of the performance of the long term has been, pulled forward per se. And so I don't think that performance would be as stellar as it has been over the last 15 years when we think about the future. So I'm extremely cautious. I don't think that the returns of the last 15 years will carry over the next ones. I think it's going to be, a change of leadership as well. Last but not least is the gold to silver ratio. A lot of times we look at charts and you see this stretch, sort of historical situations where something looks very stretched. And I firmly believe there's two types of investors, the ones that try to explain that and say this time is different, which is a fine approach. You always want to ask yourself, is this time different? Are there any fundamental reasons to believe in that? I tend to believe in history. I tend to put a much higher weight. And of course, there's always risk for something to be different this time. Since COVID, we've seen a lot of things that have been different, this time. And so, which is funny because in 2008, a lot of people said it's going to be different this time, and it wasn't. We did see big changes. And usually it's a funny phrase that we hear in Wall Street. It's going to be different this time. It never is, right? But this time, I also don't think it's going to be different. I also think that the gold to silver ratio is poised to move substantially lower. And for those that are extremely negative on silver per se, just because of the underperformance relative to gold, that actually excites me. That level of skepticism with silver at a healthy $30 to $35 ounce sort of range that we've been seeing over the last few months, with a gold to silver ratio at 100, excites me a lot. I feel very confident on taking the view that the silver will likely outperform a lot of hard assets, not just financial assets. And so it's been on top of my agenda, at least, to look for ways to express that view as best as possible.